we
all
made
are,
it.
20 minutes late.
Better late than
in the
never.
church. There you go. You know how you do in the church and you walk across with your finger up, like nobody can see you.
And nobody can
right
see me.
now.
I'm just sneaking in. I'm just sneaking in.
Just sneaking by. But hey, better late than never, right?
Yeah, like closing an escrow, right?
There you go, just like that.
We closed late, but at least we closed.
Hey, we closed. You got them keys. Let's not complain.
That's funny.
Absolutely.
Yeah. On time is great. Just get it done.
Yep. Yeah, let's just get it done. So
well, I guess we can just dive right in, huh?
Let's dive in. Let's get it. It'll be super short today. So
it is. We started late and I got a flight to catch.
Yeah, you got a flight to catch, and my client is waiting on me to get back to her house.
Get back over there with some more boxes and tape.
Yeah. So I'm helping her out today. So yeah, we got 30 minutes that we can do. I told her I'll be back about 1:10. So
awesome. Well, I mean, mortgage rates is kind of, I guess, right up my alley. So I can lead off and see if you got some questions along the way. But you know, everybody, the most common question I get asked on a regular basis is, what's today's rate? Like, well, what you want to pay for it? Like, that's the honest answer. So I think I've shared this before, that an interest rate is really just an index. It's really just a number. And it's really just a number. And rates change daily. Rates change by the hour. Rates are really just like the stock market, where there are published rates, right? So you can see some advertisement. You can go to bankrate.com. You can go to different websites and you can see what they say today's 30-year fixed rate is. But what's hidden from that advertisement is two things. One is the qualifying conditions, right? So it's usually somewhere in the small print or real fast on the radio, 50% loan value with 725 score, blah, 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 blah. Like they yell out all that stuff. So rates depend on so much that there is really no best way to quote a rate without actually digging a little bit deeper than the surface. What is your FICO score? How much money are you looking to borrow? Because that has to do with conforming loan limits, jumbo loan limits, even super jumbo. How much loan to value you're looking to borrow, right? 50% of the purchase price, 90% of the purchase price. All of those things affect the rate. And then on top of the rate there's different rates. So there's your normal government rates backed by Fannie and Freddie Mac. There's your FHA rates. There's your VA rates. There's your fixed rates. There's your adjustables. There's 1 month adjustables, 1 year fixed, 3 year fixed, 5 year fixed, loan that will adjust once a year, loan that will adjust every 6 months. And all of those different things affect the interest rate. So
that's a lot.
That is a lot. But people don't want to hear that. Yeah, they just want to hear what's today's rate. So, 6%. That sound good? Then it's 6% today. There is some stuff that moves, right? So there's a lot of misconception, and this is big. A lot of people think that when the feds have their meeting and they adjust the rate, the prime lending rate, that directly affects mortgage rates, and it does not.
Okay.
Yeah, mortgage rates are not tied to the Fed rate. Now, HELOCs, home equity lines of credit, those are tied directly to prime, because most equity lines are going to be prime plus or minus something. And so as prime goes up, if you're prime, let's just say you're prime, and prime goes up a quarter, then your rate went up a quarter. If you're prime plus 1, that means you're 1% over prime. And when the feds adjust that prime rate up by a quarter, you are now 1 1/4 higher than that rate than it was yesterday or this morning. Back in the days, there used to be a thing called LIBOR, LIBOR, and a lot of adjustable rates were tied to that. And that was like the London International Bank of Offered Rates. That went away, I think, about a year ago. And now there's a SOFR, the standard offered rate, Fed's rate. There's the constant maturity rate. So the constant maturity rate is pretty close to prime as far as how it moves, but it's actually like the Fed funds rate. So the Fed fund rate is what banks exchange money for. Banks lend banks money overnight, and that's your prime rate. That's the Fed's fund rate. And then the CMT is tied closely to that, and it's an index that moves up and down, and then you always add your margin to it. I actually have like a little snapshot here I can share. Let me see. Screen, share, boom. Share. So this is a real good indicator of how rates move. This was actually from October, which prime has moved a little bit more. And so these rates pretty much follow a trend, and you can see. And this is something that I try to show clients on a regular basis, is that this line down here on the bottom, these two lines actually below the 6% mark, that's an adjustable rate. And then above that line, starting around the 7.5 and going forward from there, that is a fixed rate mortgage. And this is 30-year historical data being shown here. And a lot of people are scared of adjustable rates because they adjust, but you know, proof is in the writing, writing's on the wall. It's all about numbers. And if you can see, even as rates adjust up and down, an adjustable rate is never higher than a fixed rate. Some people just like that security of knowing, hey, my loan is at 4%, it's going to be at 4% forever. And let me see, I'm right here at 4%. And you can see, let me see, right on this screen, I think I can.
All right, Antonio, kind of dig into that a little bit. So you said an adjustable rate is
Yes,
never lower,
never higher than the fixed
never
rate.
higher than a fixed rate.
Correct. And
Okay.
this right here is one index. It's the CMT, but it would be the same pretty much for every adjustable rate that there is. It might be closer to the fixed rate number, but it's still going to fluctuate less. And this is my prime example. So right here at the 4% mark, so that line is coming across here. When rates were at 4 and below 4, everyone was happy with this right here. That's when everybody was walking away with 3.5s, 2.9s, like really good rates. Well, if you would have gotten into an adjustable at that time, look where you would have been at.
Wow.
Below 9%.
Yeah.
I've got a colleague of mine that has a home loan. I think he's at 1.6%. And he took that back when everybody was on this 4, he took the 1.6% and he was winning. Yeah, it's, you know, there's more fluctuation in an adjustable rate, but at the end of the day, you're going to save money. You're going to pay less in interest. And when it does adjust, if it ever adjusts to a part that's uncomfortable, you literally refinance back into another adjustable because again, they're always lower than a fixed rate. But yeah, that's just short of how fixed rates compare with adjustable rates, and adjustable rates. They do move, right? So this was low, this was low. Rates came up, the adjustable rates came up, but even when this hit its peak at, was that 5%? You still could have got into an adjustable around less than 3%.
Wow.
Yeah. So
now,
for a lot of first time, go ahead. No, go ahead.
No, go ahead, because you were going somewhere with first time buyers.
Yeah, I was going to say, for a lot of times for first time buyers, the issue is affordability, right? If they haven't saved for a large down payment, if they don't have their debt to income ratio under control, spending habits under control, but they're stuck on, oh, I'm getting to a fixed rate because that's what my grandparents said to do.
Right.
Well, you're going to have a higher payment. A easy way into a home with a cheaper payment is to look at a 3-year or 5-year adjustable. So again, those loans are amortized over 30 years, but you're going to get a fixed period of like 3 to 5 years where the rate won't adjust. So if I can give you a lower rate today, and that rate will stay fixed for the first 5 years of the loan, and that rate is lower than a 30-year fixed, why would you not move into that product? You say, well, what's going to happen when it adjusts? I'm going to refinance you into a better loan.
Right. You know what I think a lot of people are more afraid of, and this is what I hear, is that, okay, if you go with an adjustable rate and then they get in, and I think this goes back to that 2007, all that craziness, 2008, what we saw back in the day.
Mm-hmm.
I think, am I frozen?
No, I see you moving and
No?
talking.
Okay. I think it's mine is frozen. But I think it's scary for people because of the fact that they're thinking about 2007, 2008, whenever you saw that. And I know it's not the same, but that's the first thing that people think about is people got into these homes and their payment at one time was, $1,000, and then it went up to $3,000 just like that. And that's a big, so I think that is what scare people whenever it comes to the adjustable rate thing.
Absolutely.
That type of thing. Yeah.
And let's talk about that time frame, because
Yes.
the first thing is I'll say is that mortgage rates and how they are sold to consumers is more highly regulated now than it was back then. That's number one.
Right. Yeah.
Number two is the adjustable rate platform has changed entirely to where certain loans are not even permittable anymore.
Okay.
So what really happened back then was twofold. We'll go with the underlying issue first, which was market values were inflated so quickly that, your house gained value overnight, 50,000, 100,000. You bought a house for $500,000, and 6 months to a year later, it was worth $750,000. These were real things happening back in 2008, prior to 2008, 2009. Okay. Now, another thing that happened was the adjustable rate loans that were on the market then were different. Now, your regular fixed for 3 years, fixed for 5 years, that stuff was out there and it was still safe. But what had a lot of push back then, and I'll say push because it was pushed on the people, was something called a pay option arm. And that is an entirely different beast, which is no longer available, number one. But that's why people got in trouble. And I'll just run it down to you. So back then, this thing was called pay option arm, or option arm. That is what was being sold. And it actually came with 4 payment options on your coupon every single month. You had the option to pay the minimum payment. You had the option to pay the interest only payment. You had the option to pay the 30-year or the 15-year. Like those were the options every single month. Boom, pick one. Here is the problem. The minimum payment was at 1%.
Oh.
Which
so
was
guess
less
what people
than,
were picking?
They were picking at 1%. Now that 1% was not your fully amortized rate. You got a 30-year rate, which was 5%. Let's call it 5. Okay. You got a 30-year rate at 5. You have the interest only option at 5. So if you owe $500,000 and you make the interest only payment, you still owe $500,000.
Right.
If you did that all year long, you still owe $500,000. But people looked at this other option of 1%. Well, the difference between 1% and 5% is 4%. And so that 4%, it's not forgivable just because you decided to make the minimum payment.
Right.
What they did is they took that difference because you didn't even make the full interest payment. So the difference between your minimum payment and the interest only payment was tacked on to the back end of the loan. So now you owe $503,000. The next month you owe $506, $509, actually going up more than that because $506 amortized. It just kept tacking that along. And then this is what happened. Now, because I made the minimum payment for a whole year and at the end of the year, I owe more than I borrowed, no big deal. But then when it hit that adjustment and my fixed rate went from 5% to 7%, and I didn't have the option of making the interest only payment anymore.
Yep.
Now my
That's
payment
the problem.
$2,000. Let's say it only went up $2,000.
Yep.
Well, that's not a little, but that's, let's just say it only
That's a
went up
lot.
$2,000. I can't make my payment.
Mm-hmm.
Where's my minimum payment option? No, that expired. Where's my interest only option? That expired. You now owe this and you need to make a full principal and interest payment. And that right there made people not be able to afford their home. And then
Yep.
that underlying issue kicks in now, right? I can't afford my payment, which means I'm probably going to lose my house. So let me try to refinance. I borrowed $500,000, but because I've been making these negative payments, negative amortization, less than interest only,
Mm-hmm.
now I owe $550,000 or $600,000. But my house is only worth $550,000, but I owe $600,000. I can't refinance. I'm trying to borrow more than my house is worth. And that conundrum, anyone with common sense, unfortunately, would say, well, wait a minute. I have an asset that costs more than, or my liability. I have a liability that is worth less than, or I have an asset that's worth less than the liability tied to the asset. I have a home that I owe more money than I can borrow. And I can't refinance because the value of my home isn't what my loan has grown to. Now, even if you were in an appreciating market, that was a real hard grade to keep up with. It's like, okay, my loan went negative $100,000, but my home value went up 100,000. But now you're trying to refinance 100% of the value of your home, and you can't.
And you can't.
And maybe you can't even afford the DTI. You just don't qualify. And then that is what triggered I'm going to let my home go into foreclosure.
Yeah.
And then that domino effect is, if my house goes into foreclosure, what happened to my neighbor's value? Lower. Now, the whole neighborhood value starts getting lower, and I'm someone else in a neg-am loan, even though I've been making my payments on time, and I want to refinance. My house is worth less than what I paid for.
Right.
My house is worth less than the loan that I have. Wow. Like, that is what scared the bejeebies out of everybody in 08, 09. And again, there was a three-pronged issue there. Number one, home values went up, skyrocketed. Number two, that was a negative amortization loan, not a regular adjustable rate mortgage. And number three, the honest part is most people shouldn't have been in those homes. That loan was so easy to qualify for that anyone who had a post could have that loan. And you put that out there, and that's what happened. So I would only say, very simply, adjustable loans are not the same type of adjustable rate loans that were around in 2008, 2009. Those things also came with prepayment penalties.
Where if you tried to pay your home off early, they will penalize you for it.
Yes.
Yeah.
And they were like,
so
1 year.
Changed. Yep.
Yes. So now, if you own a home as a primary principal residence, this is your owner occupied home, you can't even have a prepayment penalty. That's not even allowable. Investment properties, it's on the table, and you can barter, you can do that. Now, why take a prepayment penalty? If I take the prepayment penalty, I'll get a better rate, because what I'm doing is I'm assuring the lender or the investor that I'm going to stay in this loan for X number of years. So you can calculate your earnings, Mr. Investor, knowing that I'm going to be paying this percentage rate for 12 months, for 24 months, 36 months. And if I get out of it, I will then, in exchange, go ahead and give you 6 months interest up front. But now you can't do that on an owner-occupied home. There's some subprime stuff, the non-QM market, some of the stuff where you don't need a FICO score to qualify, you don't need to prove any income. Some of those you can tie a prepayment penalty to. And again, it's just security for the lender saying, well, if you want to refinance out of this, that's fine, but you're gonna have to pay me some money.
Yeah. I mean, so tell me this, okay, because I think I looked at the mortgage rates, this, and I know you say they, of course it fluctuates, but on my little mortgage alert that I get every day, it was like 6.75. is about what I saw. And like you said, that can go up and down, and it just depends on if it's what your credit look like and all sorts of things.
It does.
Now,
So go ahead.
Okay, so say someone right now wanted to get a mortgage. I got somebody that I'm gonna send over to you today, as a matter of fact. So they're looking to get a mortgage. Of course, they're scared of that 6.75 interest rate.
Mhm.
Can you dive a little deep, and we do this every call, dive a little deep into making them feel better that they don't have to walk into that rate at 6.75%. If
Got it.
everything else adds up, if their DTI is not crazy, if they have the income and the credit score is there, what does that look like?
Well, so there's two things there. Rates are what you're willing to pay for them. And that, I think, is one of the biggest things is you see a rate and you think there's my rate. And a lot of people do know this term of what they call it. Sorry, loss of words here. It's discount points. A lot of people understand the term of discount points, right? So you pay fees up front, and it's a percentage of the loan amount, and that will permanently reduce your interest rate. It's not a fair exchange. I'll just be honest, right? It's like, oh, I'll give you $5,000 more, and you're going to change my rate by 8. Then you got to do the math. How long will it take me to recoup that $5,000 that I paid up front? If I'm saving $500 a month, cool. 10 months later, I'm broke even, and now I'm really saving $500 a month. But an eighth of a rate difference is not going to save you $500.
No.
Save you $30, depending on your loan amount. The other thing that can save you from the sticker shock of 6.5 as a rate, right, is the temporary buy down. And that's huge right now. That's where you take seller concessions, so seller credit, and you apply that to the closing costs in the form of a temporary buy down. And basically that money makes up the difference between what you pay and what's really due. So let's just say the mortgage payment is $2,000. Seller gives you some closing costs. You use it for a temporary buy down. We'll get your rate down to where your payment is $1,500. And then that seller's money is in a pool, and then $500 goes in there every month to help make the full payment. So you never get in no negative amortization. Your full payment is being made, but it's being made in two parts, partly by you and partly by the money that the seller gave you to close. So instead of using it for closing costs, or instead of using it for, like some new carpet, as long as you get a temporary buy down, and you can literally take a rate that's 3% less than the sticker value. Yeah. So if rate is 6.5, what you need to know is we can close you at 3.5. And I'll show you the payment at 3.5, and we'll see if that's affordable. And that's going to be your first year. Next year, you'll be at 4.5. Next year, you'll be at 5.5. And then on that fourth year, after you use your discount for 3 years, you'll be back at that 6.5 rate. But most likely we can refinance you into a lower fixed rate ahead of time, right? So as soon as we see rates are in the 4s or 5s, we get out of there and we do that. And then the question might be, well, what happened to the money that the seller gave me to supplement that payment? That goes towards principal reduction. So that money is not lost. If you take 10 grand from the seller and over a year, you only use $2,000, and we refinance you next year, that remaining 8,000 goes directly towards principal reduction. So it pays down your loan so that you're only refinancing what you really owe after that discount. And aside from that, it's really about how your loan officer, how your broker structures your loan. So can you see my screen up on LOS right now?
I can, yes.
Okay, so let's talk about it real quick. You saw a rate today, you said around 6.5 or 6.75?
Yeah, it was like 6.75%.
Okay, so let's just throw out some scenarios here. What's a good FICO score? The borrower you mentioned, do you know where their credit is?
I want to say that, they are pretty high. They're like a 700.
Okay.
Yeah, their credit score is about a 700.
Let's go 700 FICO. Let's go 50% debt to income ratio, because that'll get approved. Reserves don't really matter as much in a regular conventional loan, but I'll say none, just so no one says, well, that doesn't work for me because I don't have any. Let's go first-time home buyer. And let's talk about that real quick too. We talked about this in the past, but first-time home buyers are getting better rates right now than someone who owns a home buying another home. Okay, someone who has 50% of the money and only needs to borrow the other 50%, compared to someone who's a first-time buyer out the gate and needs a whole 96.5 or all of the money, they're going to get better pricing on their rates because finally the government has stepped in to try to even the playing field a little bit. They're like, look, this person doesn't own a home, and we're going to make it a little bit easier for them to get into one. So the loan to value box here, where there's pricing adjustments, there's going to be less price adjustments to the first-time home buyer than there will be to someone looking to borrow, 60 or 70% of the money, because you already own a home. You've got tons of equity. You've been in the game for a while. Let's let other people get into the game. So let's look at a conventional rate, 30-year fix, right? Everybody likes that. It's safe. $500,000 is the purchase price. And, obviously it's better appraised for the purchase price. And, you do 20% down, because I can tell you right now, the rate that's being advertised is typically someone with good FICO score and someone with a large down payment. We'll go primary, single family residence that they own. Give me a zip code out there where you're at, Ms. Jones.
30016.
Right. Right, we're gonna go into Newton County.
Yes, where everything is going.
And we're gonna say full doc. So what that means is that the person can verify their income over the last 2 years.
Okay, check stubs and everything like that.
All that
bank
good stuff.
statement. Yeah, all that good stuff.
All right, and so this is just one version of some software we use to search rates across multiple lenders at one time.
I remember we saw this one time before.
All right, so got 1,432 different rates we can push across the board today. And so here's a 6 and an 8, 6.25. And in this column, what we like to see is green. We like to see 100 or better. When it's better than 100, everything that's over 100 is money on the table to help the buyer or borrower with their closing costs. So this 0.250 would go back to the buyer. Anything under 100 is where we start talking about them discount points, right? You need to make this 100, so you need to come in with 0.059 of the loan amount, and they just let everybody know what that is. $500,000 times 80%. That's 400,000 times 0.059. You're talking about on that loan amount coming in with $236. That's nothing.
Right.
Sometimes the discount points can get over 1% though. So $400,000 loan, you're talking about $4,000, right? But this is where rates are at, 6.375. And these are all good numbers here. So no added cost to a borrower. Okay, now you talk to one borrower and they like the rate. They don't want to pay. They want to see how far down we can get the rate.
Right.
So here. So now here's a rate stack. This is something else that affects rates that doesn't get talked about very much, is how long we lock your rate. So typical escrow is going to be 30 days. So we go in with a 30-day lock. If we're ready up front, we got all our documents in line, and all we need to do is order the appraisal and get the home inspection cleared, we can easily go with 21 days. If we, for some reason or another, had to shop around for a house after we already got qualified, that one fell out, but we're ready. Like our stuff is with the underwriter, everything else, we can go with a 12-day lock, and you see that the cost on a 12-day lock, sometimes it gets to be a little cheaper, right? So here's a 30-day lock on a 6.5% rate. It's got good credit to it. which means that money, that
Mm-hmm.
0.875 can help with the seller's closing costs. So on a $400,000 loan amount, we can give the seller $3,500, or the buyer, sorry, we can give the buyer $3,500 to help with closing. Now, if we're ready to do this in 12 days, we can give the buyer even more money. So now we're talking about 400,000 times 1.125%, and we're close to $5,000 in closing cost assistance. And when I say closing cost assistance, this is just credit right from the lender. This is not down payment assistance. This is not anything from the seller. I want my rate to be even lower, then go back the other way. And actually, they're not going to let you get less than 6%. And you're going to have a cost of about an eighth.
Mm-hmm.
Okay. Let's see what Plaza Mortgage is talking about. Where did Plaza go? So here now you see all the different loans that they have. These are different underwriting, underwritten by LP or DU. Home style, this is like income. I wouldn't say income like low income, but this is medium income. So you got to be at the medium income or below. You cannot be too high over the medium income, and you qualify for a discounted rate. These are different buyer programs, more or less. So go in here and okay, so the floor rate here on this guy is going to be 6.49, and I'm going to let you get any less than that. But your 6.5 rate comes with a rebate. So if someone asked me what today's rates were, I'd probably say 6.5. I could easily say 6.25 because, again, on the broker side of things, we tend to have the flexibility of shopping around. And so when this pops back up, it stacks them from the lowest rate available to the highest rate.
And, you know, Antonio, one thing that just keeps standing out to me as you're going over these numbers and everything is there's so many options. And you're not going to know where you stand and what you would qualify for until you fill out the application, fill the application out.
Yes.
I mean, do the application. That's the only way you'll know, because there's so like you said, with low income, if you had somebody with low income, if you had somebody that made, you know, a lot more money, there's options across the board that could get you into a home. Yep. But you have to start with the application.
That's square one. And it's so funny that we even have to talk about that, because
because people
this is the largest purchase you'll probably make your entire life.
Yeah.
Right? This is, unless you buy another home later, but this is the largest purchase you're going to make your entire life. And people say, well, what are the rates? Well, let me get you to fill out an application. I don't want my credit ran. No problem. We can do a soft credit. Won't even affect your credit score. Won't show up as an inquiry. I don't think I want to do all of that. Can you just tell me what the rates are?
Yeah, no.
5%. Rates are at 1. You want to fill out the application now? And then when you fill out the application, I'll tell you, you don't qualify for the 1%, but this is what you do qualify for.
Yeah.
You know,
and then not only that, let's tap into this. I know we got like 5 minutes left or something like that left. But tell please again, because I hear people say, oh, you know, I financed my car at, you know, Citibank down the street, or I finance with Bank of America and this and that, and not to knock those places at all. But I've seen where Bank of America or SunTrust or some of the bigger banks will not approve them, but then I send them over to you and they get approved.
Yeah, absolutely.
So can you kind of go into why that is?
The number one reason is because banks have guidelines, and that's it. If you don't meet their guidelines, they don't have another option for you. It's just no, go to the next bank. On the broker side, we partner with, honestly, it's over 200 banks at this point in time. My particular brokerage has over 200 banks, lenders, investors. And so everybody has different options. That's what it boils down to, is that every lender or investor has different options. And the biggest difference that you're going to run into at a bank versus working with a brokerage or a different lender other than the bank is debt to income ratio. Most banks are not going to give you any money if you go over 45% debt to income. It's just not going to happen. They don't care how much money you have in the bank, what your track record is at work. There are no compensating factors. If you're at 45.01, don't qualify.
Yeah.
$100,000 a year. My wife makes $100,000 a year. My credit is 740. I got 30% down. Yeah, but your debt to income ratio is 45.1, and we're a bank, we don't allow it. That's your number one reason why people get declined at banks, is because they have very strict guidelines. Why? Well, because they're making money everywhere. They're making money on your deposits. They're making money on your auto loans. They're making money on your life insurance. They're making money on your investment accounts. They're making money everywhere. So they have no reason to flex and bend when it comes to the home mortgage. So if you're not going to go to a brokerage, at least go to a retail establishment that only does home loans.
Right.
As soon as they branch out to auto financing, equipment, personal loans, CDs,
too much going on.
Too much risk involved, so they tighten up their qualifying guidelines everywhere, and that's going to be your biggest problem. The other reason is minimum FICO. Most banks won't touch you without the government 620 for a conventional loan, and in a lot of banks, they just take themselves out of there. We only want borrowers with a 700, 680 or better. Okay, whatever their guideline is, they're stuck there. Working with a broker, I mean, I kid you not, I've done 100% financing for a guy with a VA loan before with a 502 FICO score, 502 FICO score, 100% financing VA loan. 580s, we can close all day long on government stuff like FHA. And 620, that's a box that no one can break. Conventional loans, the 620 FICO score.
Right.
Yeah, there are some compensating factors that will get us less, but not that same loan to value, not maximum loan to value. So you can come in with a less score, but you're gonna have some skin in the game.
Yeah.
Yeah.
Some good stuff, Antonio. Some good stuff. And I'm hoping that, more people will reach out and, get the process started. Because we can talk all day. You can ask every single other day how, what are the rates like, or are they going down and this and that. But, if you're not filling out that credit application, at least getting the product, getting the process started, you're just spinning your wheels. And next year, it'll be the same thing,
Yep. Rates change regularly, but without a roadmap to get you from here to the home, you're going to always be thinking rates can be better. They can, and they can be worse. Yeah. Bottom line is, if you can afford to get into a home today, you move into that home today. You start the process now. And, there's no money to fill out an application. Now, there are some fees in running credit, right? So let's talk about that real quick. Some people don't want to pay to run their own credit report. I don't want to pay for that. Okay, fine. But when you close escrow, we're going to get the money back anyways.
Yeah.
But if you don't even want to invest into looking at what your credit looks like, that's a telltale sign. I mean, when you go and apply for an apartment, don't they charge you an application fee?
Pretty much.
Yeah, they charge an application fee. They charge you a credit check fee. If they don't charge the credit check fee, it's just built into the application fee. So, there's a little QR code somewhere. Let me see. Right over
right.
There.
Yep. Over there you go. There you go.
There it is. Right there. That QR code. Scan that. It takes you right to an application. Fill out the application and fill it out completely. What I mean by that is you need to put your job in there, because FICO score and income is not it. If you make 6 figures, but you've been on your job for 2 months and you don't talk about that part up front, then that's going to be a hurdle later in the process. So fill out your application, fill it out completely. The only thing you should leave off is like bank account information. No one needs your bank account number yet, right? So we don't need that. We need to know if you have a bank account, and if you have a balance, put that in there. Put your job information in there, when you started, how long you've been there, how long you've been in this field, and put in your income. And we count gross numbers. That's important for people to understand. what you're taking out of your 401k and all your benefits and all that stuff, that's on you. You can adjust that at some point in time. So we count gross income numbers. Unless you're self-employed, then we go off of taxable income. But fill out an application. There will be a soft credit check that's no cost to the consumer. It costs us about $24 to run that, and we look at the credit without it being an inquiry. You'll never know that your credit was looked at. It's called a soft pull. And from that, we can calculate your debt to income ratio and tell you what you qualify for. And then the next step is a conversation, because you might be able to qualify for more than you can afford. So let's figure out what you qualify for, and then we'll talk about what's a comfortable payment, and we'll meet right there at that intersection. And that's how you get pre-approved for a home loan.
I so appreciate everything.
Yes, ma'am.
So hopefully we get some reach out, and if anybody have any questions or anything, you can reach out to Antonio or myself, and we'll see y'all next Thursday.
All right.
All right. Talk to you later.
Talk to you later.